Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now in today's episode, let's delve into the world of smart beta funds, funds that combine active and passive investing. Dhirendra, welcome. Let's start today's episode by explaining what is so smart about these funds.
The smart is actually a corollary of being dumb. So to understand what is smart beta fund, you need to understand what is beta. Index fund generate returns, which is referred as beta.
Okay.
If you take no risk, no untoward risk, if your portfolio is just weighted as the index, you will get what is being referred as beta. It is basically a measure of volatility. Anything which is very much aligned to the index moves up and down as the index is referred as beta with 1. Beta with 2 means twice as volatile. With half means half as volatile. Beta being referred as index, trying to make index smarter is smart beta. And most of the smart beta funds are mounted on an underlying index. It will be one of the index, BSE 500, Nifty, Sensex, whatever. And then there will be an overlay of rule. Overlay of rule to make it an interesting story, make it a compelling story, making it a credible story which can generate superior return than index in a predictable way, with a predictable behavior. I'm just trying to list, all the kind of smart beta funds created so far in India. There are about 30 of them, little over 30. And the first one is, the one which we have most is equal weighted index. In your Sensex or Nifty, you have some stock which has a weight of 10% or 11%. Then there will be another stock which will be part of Sensex or Nifty. But then it will have a weight of 0.5%. Its impact on daily movement will not be that significant. So by making it equal weighted, the theory is that all the constituents will do well. But by its very design, the index is created with, which is differently weighted, where the bigger gets bigger and the smaller gets even smaller. And as a result of which, many of the smaller companies or companies with smaller weight, they get very marginalized in that index. So having an equal weight gives everything an equal opportunity. And when there is a reversion to mean, when companies will be out of favor, which will have a lower weightage, when they get in favor, this fund will benefit. So equal weighted index are the largest number. Then there is alpha, similar thing, where somebody is taking a universe and some methodical quantitative yardstick is trying to spot those companies which will generate superior return. So drop some companies and add some, higher weight to some company, and that is alpha. Then low volatility index, low volatility funds, where, the fund is attempting to add or delete some stock from the index so that it is less volatile. The most popular one which has worked in last financial year or calendar year are the momentum index. Here, within an index, somebody is trying to apply some formula or a quantitative methodology that these companies have the momentum. And if the momentum sustains, then this will be the best. This fund will be able to ride that index, ride that momentum well. And this is something which has done wonders. There are 2 funds which were able to attract the most money because they were able to deliver the most return. The other side of this is that this is like a semi-active management. Semi-active, but semi-active management with a discipline, because it is based on a formula, it is based on a premise, and it will automatically happen. Because it is mounted on an index, there is a certain set of rules which will be applied, and that is how it will work. Now, something which has done exceedingly well will also go out of favor.
So there will be cycles.
There will be cycles to it. So nothing prevents these funds, smart beta funds, to insulate them from the declining phase of the market. Right. And so far, my sense is that many mutual funds are launching this smart beta fund also because they are finding it, difficult to beat the index many times. These are the kind of funds which, if you are able to create one, you can launch it without worrying about SEBI's classification rule, because there is no such restriction here.
Okay. Now, to understand them a little better, can you explain what are the benefits and drawbacks of smart beta funds?
One advantage of smart beta fund is that they are disciplined, and you exactly know how they will behave at all times.
Right.
They are not going to go, there is a boundary in which they will operate. And one disadvantage is that, they are looking to me as, if I have to choose a fund, I will look at it like any other actively managed fund. And it will lose out on one of the key advantage of actively managed fund, is that a fund manager can actually choose something which no index has it. Because, this will always be, the problem of index fund or a smart beta fund is that it will always be with a stock, which is part of some universe. And there could be huge opportunity once in a while, where you go beyond the index, and that is where some of the biggest gains come your way.
Okay, and that's what active investing
Active is all about.
All right. Now, finally, who should invest in these funds and who should not?
I think, you should look at it as any ordinary equity fund. And the way they crop up as an option, just evaluate them like objectively the way you will. If one of these funds qualify, invest in them. Otherwise, don't.
Okay.
Look at them as normal fund.
Okay. All right. Now, before we wrap up today's episode, there's a viewer's question that we would like to answer. It's been sent by Hardeep Sidhu, who says, I'm a science teacher in a government school. My current salary is 72,000 per month, and around 18,000 of it gets deposited in NPS Tier 1. I'm thinking of taking a personal loan of 5 lakh rupees from bank at the rate of 10.25% to invest in stocks by buying value research portfolio plan for 3 years. He also says that in case of market correction of around 10%, I can take another 5 lakh rupee loan, and I want to stay invested for 8 to 10 years. He wants your suggestion on this.
One is that it's a good idea, but don't do this, because my basic rule to be followed at all times while investing in equity is that it should be your long-term money, which he thinks is long-term money. But you should never invest with borrowed money, because odds are against you. Assuming that you borrow 5 lakh rupees and you invest, and your 5 lakh rupee becomes 8 lakh rupees in 2 years' time, which is good news. And after that, it will also crumble sometimes, and it will become 4 lakh rupees overnight or in 2 weeks' time. That is the time when you will actually go out of idea. You'll be out of ideas. Good times, you feel happy. But that kind of steep decline in a brief period will actually drive you out of the market. The other problem is that why you cannot be patient with your money investment when it is borrowed money. Because you can be patient with your own capital. Okay, I have invested and it has not gone, it's not doing well, but you will hang on. Here, you can hang on, but your interest, the meter reading is going up. So you'll be worried about it. You have to pay the interest on the capital that you have borrowed. That is one. The other is that, there might be an opportunity. I don't know whether he is a central government employee, whether he's a teacher with establishment which is a part of central government or the state government. Right. But he's part of the NPS. And the NPS generally, the way it is working, is that 10% of your salary is deducted. 14% is provided by the government, and it goes into that investment account. Now, recently, there is a very dramatic or, significant improvement that has happened, or enablement that has happened. And he should seriously consider it and try and find out whether it is possible in his case. So far, your deduction of 10% and 14% contributed by the government was getting invested in the state government or the central government plan, where the equity component was only 11%. Now it is possible to invest in a plan which is the life cycle fund. And if you invest in the life cycle fund, and if you are young, then it can have far higher allocation than 11%, that is the maximum in the state government or the central government plan. Right. That can well go up to 30, 40, 50%. And that way he will be able to realize the kind of benefit he is trying to derive by investing the money, by borrowing. So consider that. And the other thing which I would like him to do is, instead of borrowing, do some parallel savings. Besides your, if you are able to save a little bit, do your SIP. Once that becomes 4-5 lakh rupees, then consider building your stock portfolio. There are two key advantages of it. One is that once you invest in an equity fund and do your SIP, you will get used to, or you will get an opportunity to acclimatize yourself with the equity market. Because markets are crazy, and that is why they proved to be rewarding, but most people are unable to derive the benefit out of it. So you will partially get used to it. That's one. The other is that use this 2-3 years period in which you will be doing your SIP in terms of developing a temperament and developing an expertise, how to look at a company, what works in investing, what does not work in investing. Because investing has become very easy. That doesn't really make it that it's a very easy way to make money from investment. Because investing has become easy and you can very easily lose money if you're not careful about it, if you're not doing it thoughtfully. So it will give you an opportunity to step back, experience it, and develop your framework of how to think when investing in shares.
All right, Hardeep, hope that answers your question. That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thank you for watching. Take care. Bye for now.